Hello, everyone. Welcome. I'm Catherine Bracey, the founder and CEO of Tech Equity Collaborative. Thanks for joining us for this event today. We are just going to wait a few minutes for the room to fill up and get started shortly. Hello to those of you who have just joined us. I'm Catherine Bracey, founder and CEO of Tech Equity Collaborative. We are just waiting for the room to fill up and we'll get started in just about 1 minute. Okay, I think we're going to go ahead and get started. Thanks everybody for joining us for this event. For those of you who just got into the room, my name is Catherine Bracey. I am the founder and CEO of Tech Equity Collaborative, and I'm very happy to be moderating this event on rent to own, alternative financing models in the housing space. Before we get into the panel, for those of you who are new to Tech Equity, I just want to give you a brief introduction in who we are. We are a California-based organization whose mission is to ensure that the growing tech economy is creating broad-based opportunity for everybody rather than driving inequality and displacement. And we do that through three ways: education events like this one that you're attending to understand issues in the space that we work in. We do public policy advocacy, advocating for policies that we think will make a growing tech economy create broad-based opportunity for everybody, and also corporate practice. So we work with companies and create resources and ethical frameworks and standards to help companies adopt practices that we think will enforce those values that we work on. And we do that in two areas, housing and workforce and labor. Obviously, we'll be talking about a housing issue today, which we're very excited to get into. Before we do that, just a few housekeeping announcements. First of all, we enforce a code of conduct at all of our events. Our community manager, Herman, will be in the chat and we'll post a link to it, and we'll be enforcing the code of conduct in the chat. We leave the chat open so that you all can talk to each other while the panelists are talking, but we really ask that you follow the code of conduct while you're in there. It basically just says, help to create and maintain a safe space for learning for everybody, respect everybody's point of view, and no rudeness, name calling, or taking up too much space. For Q&A, we will have a Q&A at the end of the conversation with the panelists. For that, we ask you to use the Q&A function. So if you have a question for the panelists, feel free to ask it at any point, but use the Q&A function, not the chat function for questions. And then we are recording this webinar. We will be sharing it out and posting it on our website after the event, and we encourage you to share it more broadly with your networks. And then lastly, we have Michael here joining us. Thank you, Michael, for doing the ASL interpretation. Zoom has a new feature for interpretation. If you notice the bottom of your screen, there's a little icon that says interpretation. If you click that icon and select American Sign Language, Michael will pop up and be much clearer to those of you who are using the interpretation function. So with that, I want to get into the conversation. This conversation is part of an initiative that Tech Equity launched about a year ago called the Tech Bias in Housing Initiative. And the purpose of that, we've been working on housing advocacy for years at this point. And we kind of saw issues arising in the space that were connected less towards, traditional housing policy issues and more around the rise of this fast-growing emerging sector called prop tech. These are venture-backed, tech-enabled companies, startups that are working in the housing space, and the potential equity, social and economic equity issues that those companies are creating, exacerbating, and in some cases have the ability to help mitigate against harms that have happened in the housing market in the past. So this initiative looks at, kind of raises awareness around those issues, proposes some regulatory frameworks that could address some of the equity issues that the companies create, and then also creates ethical standards and frameworks for companies who are working in the space that they can adopt in order to mitigate against the potential harms that tech companies working in the space may create. We've published 3 papers so far in this as part of this initiative. The first one was looking at tenant screening tools. The second was looking at corporate homeownership. And the third one is the topic we're going to talk about today, which is on alternative financing models, particularly rent-to-own models. And I'm going to let the panelists kind of speak to the details of that and what we found in the report. But just to say that, this emerging sector of rent-to-own has really raised some troubling potential areas of harm that we want to highlight that grow out of and sort of their predecessor contracts for deed, which we'll also talk about, but also, create some opportunities for lowering barriers to entry to homeownership that we think are, potentially promising and that we want to maximize. So that's the conversation we're hoping to have today with our great panelists. I'm going to introduce each of them in turn and ask them to sort of speak to a specific area, starting with you, Michelle Boyd, who is the Chief Strategy Officer at Turner Labs. Michelle was a contributor to the report. Michelle, I'm hoping you can just give us a little bit of context about what rent-to-own is, what alternative financing is, and some of the historical context for the model.
Absolutely. Thank you, Catherine, and thank you to Tech Equity for initiating this important conversation. So, hi, everyone. Michelle at Turner Housing Innovation Labs. We're a nonprofit affiliate of the Turner Center for Housing Innovation at UC Berkeley. Turner Labs works directly with innovative approaches both in the market and in government to help achieve housing affordability and equity. So we've been tracking this rent-to-own industry for some time, and I'm excited to be able to dive in today. So what is rent-to-own? At its most basic concept, it is the ability for a person to move into a house and pay rent in that house while acting like an owner and having the functional right to purchase that property in the future. When we say the words rent to own, it usually involves some type of expectation of a predefined contract period, 1 year, 2 years, 3 years, 4 years, in which you're renting, that the person moving in has agreed to purchase the house at a set price called a strike price. It may escalate each year that they don't exercise it, such as starting at $400,000, escalating maybe 3 or 4% each year when you don't purchase it. And then having a contract, private contract between the current owner of the house and the person living in the house about how they handle certain things like maintenance issues or fees or late payments, et cetera. And so it looks in between renting and owning, trying to move someone into ownership. As far as who's using these types of models, the short and unfortunate answer is that we don't know. They're not tracked. Right now, public records require there to be tracking when a title of a house changes hands, so who actually owns the house, or when there's a traditional mortgage issued on that house. Rent-to-own doesn't trigger any of those things or broad recording in most states. And so we don't have any data about the racial income or other demographic data about who's using these tools. Companies that provide this product at a professional level often are intending to target people who are interested in becoming homeowners, but for a variety of reasons aren't quite ready. Either they've recently moved into a new market and they may not be ready to decide where to live, or they may not be financially ready to buy a home. They may have a credit score that's not quite right to get a mortgage. They may not have saved a down payment yet. But they would like housing stability. They would like often access to a single family home in a neighborhood where there's primarily owner occupied homes, and rent to own as a way to achieve some of that, even though they're not quite ready to take the leap into full ownership or a full mortgage commitment.
So Michelle, can I just ask, so what happens is, like, I'm a potential homeowner. I don't think I have the financial wherewithal or the, stability or whatever it is to go the traditional mortgage route. I find a rent to own company. They purchase the house for me essentially, and then I live in it while paying them monthly payments that are sort of rent, but sort of building up towards a down payment. And then as we have entered into that contract, we've agreed that at some point down the road, in 5 years or less, typically, I will buy the house from them for a pre-agreed price, right? Is that essentially?
Exactly. That's it. And how that exact contract works in between you, Catherine, and the person who owns the house or the firm that owns the house takes a wide variety of forms. So for example, whether you're just paying a quote unquote rent, or if you're paying rent plus a portion of additional money that goes into a down payment fund, is an example of the range of variety. Whether you're in charge of maintenance or not in the house is something that varies by contract to contract. And I think Hannah's going to go into that later. But essentially, yes, you move into the house. Some of the firms, companies that do this, purchase the houses and then offer them up to customers who may want to rent them and then move to buying them. A lot of the companies allow the potential home buyer to pick out a house, and then the firm comes in and purchases that house, and the buyer moves in.
Got it. And then can you just speak to a little bit of like the historical context for this model?
Yeah. So broadly, this fits into a category called seller financing, of a person trying to sell a building to someone else, kind of self-financing that transition for the person moving into the house. And this was something that was exploited and abused through the 1900s, probably before, but we have a lot of research tracking it in the pre-civil rights era in the United States, in which it was used explicitly to target families of color, home buyers of color who were excluded from traditional mortgage markets. And so we saw investors move into neighborhoods where people couldn't get traditional financing or a pathway to a home, purchase a bunch of properties, and then engage in what at that point was called contracts for deed, in which they would, very similar to rent to own, but with often without any time period attached to it, or a 30-year time period attached to it, without that option strike price, as I talked about, of the predetermined pathway towards someone building it. And through that whole system, we saw millions and millions and millions of dollars of wealth stripped from families of color, because the investors really had this captive audience of people in the house the people in those houses had very few legal protections. And so the investors were able to take advantage of them, like one missed payment, kick them out of the house, lost anything that they put into the house, lost any investments they made in the maintenance and improving it. And would often have also like balloon payments that would come out of nowhere, in which if the person living in the house couldn't pay it, they would be kicked out. So a lot of exploitation and wealth stripping that happened. This we probably did decrease in the passage of the many series of civil rights legislation in which families of color and buyers of color got access to the more traditional financial markets. However, we've seen it come and go over the past couple decades under the same title of contract for deed, which John can talk a lot about what that's looked like and what we know and what we don't know about that. The emergence of this modern under a different language of rent to own, which, as I said, to me broadly refers to these shorter contracts, something that might be a bit more professionalized or institutionalized through a company, has really come up over the past 2 decades as trying to take some of the pieces of what that seller financing was and build it into a product that maybe could work as a bridge to homeownership for some people. But as we feel, it can only be done so under the right conditions.
Right, and we're going to get into that, but I'm wondering, actually, we'll come back to this to talk about the distinctions between contracts for deed and rent to own, because they are cousins, not exactly the same, but there are some distinctions that are important to note. But I'm gonna go to you, Hannah Holloway, who's Tech Equity's Director of Policy and Research and was the primary author for this report. So, Michelle just gave sort of the basic background on what the rent to own model looks like. And, one of the reasons we're most concerned about the potential harms for this model is because of the context in which it has grown out of. While rent to own is not on the face of it as explicitly predatory as contracts for deed, there are still some red flags. So I'm hoping you can talk about what explicitly those risks are as you see them, how they're outlined in the report, and what is it about that context, both historically and also the context for today's housing market, that makes this model riskier than it might be if the market conditions were different.
Yeah, thanks for the question, and hi everyone. I think as Michelle beautifully outlined, people are drawn to this type of contract, this type of pathway into homeownership because it feels more accessible than the traditional financing options ahead of people. Maybe you don't have enough for a down payment currently, or you don't have the credit score necessary to receive a mortgage from a bank, but those aren't necessarily barriers to signing an RTO contract. Still, there is very little information on whether this type of model actually helps people successfully move into homeownership. And I would say the risks that go along with that, to me, the primary risk is just that with seller financing or alternative financing, those types of contracts, those types of agreements are not regulated in the same way as we see traditional mortgages, traditional financial institutions. And those regulations pertain to everything from underwriting standards to, disclosure requirements. So say you're a buyer and say something is either amiss with the company or maybe something goes wrong in your contract, you have fewer opportunities for recourse than you would if you had a traditional mortgage. I think the other risk, as Michelle outlined and as I kind of alluded to at the beginning, is are you actually likely to transfer or to become a homeowner in this type of arrangement? And what are the costs associated with that along the way? So you're making monthly payments, you're putting in a down payment. Are we seeing those more predatory aspects of contract for deed or CFD sort of transfer into rent to own, in which if you miss one monthly payment, your entire investment and your entire contract is sort of on the line? It's unclear, and it varies company to company what the sort of recourse opportunity is for that and what happens to your investment along the way. The risk of losing the total investment is high. And then I would also say that, especially because of the way that these are structured, sometimes with balloon payments, those final payments can be substantial enough to require a traditional mortgage at the end of the contract in order to transfer. So if you're a buyer and you're not necessarily addressing the barriers that you had to traditional financing that led you to RTO, you could get to the end of the contract and meet the same pitfalls as you would with a traditional mortgage, and not ultimately become a homeowner despite making all of those payments.
Yeah, and I guess one thing to make clear about for those who don't know, like when you buy a house, even though you're paying a mortgage and you don't necessarily own the house outright, you're paying the mortgage on it, the title is still in your name, right? So you are on file as the owner of that property. As you're paying down the mortgage, the equity that accrues in the house and any appreciation is your equity. You all also, we haven't talked about maintenance or anything like that yet. Hopefully we'll get to that as well. But any improvements you put into the house are also, that any equity that gains in the house is your equity. That's not necessarily the case in a rent to own or a contracts for deed model where this other entity owns the house. You are not on the title of the house. You are essentially a renter in that house, but you have this sort of contract with that company that says, if you meet these conditions, we will sell you the house at this price on this time frame. But I think it's also important to note that the financial incentive for the company is not to transition everybody into homeownership. It is more profitable in many cases, although again, we don't have a lot of data on what's happening in the market, but maybe John, you can speak to this from the CFD perspective when we come to you in a second. It is more profitable for the companies for you to fail in transitioning to homeownership and purchasing that home so that they keep the ownership of the home and then can recycle that relationship with a new renter who gets into the contract from day one and starts the process over. So that's also another thing to keep in mind here, is that the incentive structure is not necessarily benefiting the person or benefiting the outcome of getting people into homeownership. Michelle, do you want to jump in there before we go to John?
Yeah, just to clarify that the modern way that some RTO models, not all, have this balloon payment, this like forced payment to transition, is it's either that the individual has to put together a down payment to transition to a mortgage, and a traditional mortgage that is not brokered through the RTO company. And so that can be, depends on which mortgage you qualify for, but it could be as low as under 5% within government-backed mortgage products, which is still a lot for a family that may have entered into this contract with no savings that they could put into a down payment. So the ability to save that. And then this other piece that we heard when speaking to companies around, like, you need to have a credit score. A lot of the floors, as it said within the housing industry, of the credit score that you need to get a traditional mortgage, the floors of that for these RTO products is lower, like 50 or even 100 points lower. And the ability to improve your credit over a short period of time, especially if it's coming from an eviction or a bankruptcy, is really difficult. And so you may not successfully make that transition. And then you have a different type of balloon payment if you can't make that transition. Some of these RTO products charge a move-out fee if you can't make that transition, which is almost equivalent to the size of a down payment. And so if you're unsuccessful in making that transition, you have to hand over a large chunk of your savings, sometimes 2 to 3% of the purchase price of the house, in order to move out, and then don't have that money for a future down payment or security deposit.
Yeah, thanks for that clarity. John, coming to you, you are I think managing principal is your title at Blackstar. Can you first tell us what Blackstar is? You are probably one of the foremost experts on what's actually happening with these alternative financing models on the ground. But then can you tell us what you have learned from doing the work that you do on the ground and the position that you're seeing potential home buyers in, and how this model plays out for them in practice?
Yeah, absolutely. And thanks again to everyone for both inviting and participating in the discussion. Such a exciting topic for us, and we think a worthwhile series of issues to address. So I am managing principal of Blackstar Stability. We're a real estate investment management company that's focused on expanding the ownership of affordable single-family properties, and we do that in some ways that are unique, we think. And in particular, what we tend to do is to focus on the sort of naturally occurring affordable segment. So think properties that are $100,000 or less. And essentially what we do is to buy large pools of properties that are encumbered by alternative forms of financing, in particular contracts for deed and similar sorts of instruments. And I would characterize a certain segment of this rent-to-own sector that we're talking about broadly as particularly problematic. We tend to focus on forms of seller financing that are at best problematic and more commonly outright predatory, and try to work with the families that occupy those homes to make them outright owners. So we buy large pools of properties that are encumbered by these contracts, generally at meaningful discounts, and these are generally performing pools of those assets. We work with the families to convert the contracts that they have into traditional purchase and sale agreements that are consummated, to take back to finance that transaction with a traditional mortgage that we are providing financial backing for, holding and seasoning those mortgages for a period of time to demonstrate payment performance to the secondary markets, then selling those mortgages and recycling the capital. As we encounter this sort of rent to own property type in the smaller balance naturally occurring segment, I think there's some problems that are distinct from the broader market that are pretty acute and really hearken to the historical nature of the CFDs and a lot of the problematic elements that Michelle mentioned before. If you think about, the sort of root cause of why contracts for deed and similar sorts of products continue to thrive with the prevalence that they do today, I'd say that they're symptoms of a much bigger problem, which is that small balance mortgages are extremely difficult to secure in this country. Less than 30% of all properties that are $70,000 or less in the US are financed with a traditional mortgage. That has a lot less to do with the creditworthiness or financial wherewithal of the families that would seek to finance those properties, and everything to do with the economics of mortgage origination. If the fixed costs of originating a $50,000 mortgage are the same as a $500,000 mortgage, the industry tends not to produce many of the former. And so it's in the absence of that access to those mortgages that products like CFDs and these very aggressive forms of rent to own properties really have the oxygen to thrive. So what happens at the small balance end of the segment is that if you have a rent to own agreement, that option really isn't generally worth the paper that it's written on, because you never have a real capacity to perform on it. You have an option that exists that you can't perform on, because even if you are fully prepared, both in terms of your credit worthiness, your ability to repay, as well as down payment, it is still unlikely for most that you'll be able to secure a small balance mortgage in order to perform on that option. And so those option agreements tend to mimic a lot of the behaviors of contracts for deed, because many of the landlords who are the originators of those rent-to-own agreements are very sober about that fact. So they protect themselves in much the same way that a contract for deed originator otherwise would have. So you tend to see very asymmetric agreements where the obligations of ownership are foisted upon the tenants while the benefits never confer with them. The sorts of protections that you would associate with a typical landlord-tenant relationship or a mortgage purchased financing of a home don't exist. So they don't have the same sort. Oh, please.
You're kind of in this gray zone, right? Between, what is the clearly, say what you will about the costs and benefits of renting or home ownership. They're mostly clear what the legal frameworks are around that relationship, landlord tenant or a homeowner. And you're saying these folks are kind of worst of both worlds.
They're fish nor fowl in many places. They're largely unregulated at the federal level, subject mostly to a patchwork of state level regulations that are at best inconsistent, but even more problematically, they're generally very poorly enforced, even where the laws exist. So yes, they tend to get the worst of both.
And what's the scale of this practice? Do you have a sense of like how many people are in these arrangements, where it's more highly concentrated? I mean, I know we don't have any concrete data because this is such an under the radar practice, but just from your experience, what can you say about that?
Yeah, absolutely. So it is, there are no league tables for this sort of activity, and the best available information was a part of the U.S. Census through the U.S. Home Survey, that all of the questions pertaining specifically to contracts for deed were pulled in 2009. So we have proxies based on the sort of trends that occurred then, but that's an important time to have pulled back because it's just before the real impacts of the global financial crisis. Our best estimates based on those sorts of trends today is that it's an industry just focused on the contracts for deed that's more than $200 billion. We think it affects more than 5% of all single family properties in the United States. And that's not inclusive of the sort of broad range of rent to own contract tenants and purchasers.
Can we, just before we move on to some of the other questions I have here, I want to get back to the distinction between contracts for deed and rent to own. Can you just say a little bit more explicitly about what that difference is in your eyes?
Yeah, absolutely. So, and you summed it up neatly. The contracts for deed create an arrangement that, in contrast to a traditional mortgage where the buyer takes both ownership and possession right away, what instead happens under a contract for deed is that the seller remains the legal owner and title holder until the very last payment's made. That happens less than 1 in 5 times. And so but meanwhile, all of the obligations, maintenance, insurance, taxes, all of that tends to confer directly to the contract buyer at the time of the initial transaction. What's also important to distinguish is that it's inconsistent as to whether the contract buyer realizes that they're not an outright owner right away. So they tend to, in many cases, accept many additional obligations like deferred maintenance because they are thinking and behaving as owners right away because they might believe that they're owners. With most of the rent to own agreements, as you mentioned, that relationship's more distinct. They realize that they don't own right away, but they have a capacity to own. They may overestimate the reality of that, especially at the smaller balance end of the spectrum, but there's a clear relationship in terms of the landlord and tenant relationship. What seems like it's happening broadly as a trend in the industry is that although many of the landlord-tenant distinctions are clearer, those lines are blurring because the contracts over time are becoming more landlord-friendly. Over time, you see many of the arrangements starting to require more of the tenants to accept several of the more typical landlord obligations. But I would say that the primary distinctions in our mind is that sort of the clarity in the mind of the consumers, the clarity in the nature of the contracts. I'm sorry, one additional thing I will say is that the regulatory environment overall has affected this. And as regulators started to converge on contract for deed originators over the last 10 plus years, one of the preferred tactics to sort of avert the ire of legal scrutiny was to change the form of the contracts and contracts for deed to rent to own arrangements. They walked and quacked just like CFDs, but they technically were actually rent to own obligations that actually seemed to pique even more interest from regulators. And so it was unsuccessful in that respect, but it's important because one of the primary findings of the courts has been that while the form of the contract changed, that in many cases, the groups who were perpetrating this practice were still marketing the properties and the form of sale as contracts for deed, both to their own investors as well as to consumers. And so that lack of distinction in their minds was clear, and it's one of the problems that courts have found in penalizing some of the more aggressive groups.
Yeah, and I hope we'll have time to get to the sources of capital here and how that drives decision-making at the companies. But Michelle and Hannah, I kind of want to come back to you on the report. So we've been, painting a pretty dark picture here of the model. But the report really does take some time to lay out what the pathway to promise looks like. There is a little nugget here that is an opportunity for rent to own models to really be that lower rung on the ladder to homeownership. So what did you all find in the paper? How might those models need to look, or what might need to happen in order for this really to be a sustainable pathway to homeownership for people who wouldn't have access otherwise? Hannah, maybe I'll start with you and then Michelle.
Yeah, definitely curious on Michelle's take on this. And I guess I would start by saying that that could already be the case, but again, because of these sort of transparency issues that we mentioned, we just don't know to the extent that it's true that it is a successful bridge to homeownership. So in lieu of that, I would say, again, extending sort of the like traditional home mortgage disclosure requirements of traditional lending to RTO would be a great place to start, so that we can see if there are disparities or sort of what the data looks like around this type of arrangement, and whether it actually results in homeownership for the people who need it most. I would say at the very least, we need that type of transparency at sort of the agency, the public level. But then as John was outlining too, we need transparency for the buyers themselves. This has worked in the past through CFD because there are, in CFD's case, highly deceptive, highly complex agreements, right? And so from my perspective, RTO has a responsibility to disrupt that history, and could be doing so through things like homebuyer counseling. So HUD, the federal agency, has agencies that provide federally funded counseling to first-time homebuyers. Unfortunately, a lot of that counseling is not yet up to speed on RTO, on alternative financing models. So we would probably need to do that first and make sure that those counselors are ready to provide that sort of guidance to buyers. But some sort of agreement, some sort of commitment from RTO companies to provide that counseling to connect buyers with third-party counseling would be a great place to start. And there's also some interesting models from like nonprofit models working on CFDs specifically that I can delve into, but I know we're short on time and I'm really curious to get Michelle's take here so I can step back and come back to that if we have time.
Yeah, thanks, Hannah. I mean, I think echoing, we need data, and you need data in order to regulate, in order to know what's going on, in order to set standards. And I think and then for homeowners, knowing, people coming into wanting to buy these homes, knowing what they're getting into. Two distinct examples of that, I'll focus on one, which is, it's a complicated contract, and this came up in the chat, but like, it may make sense for a homeowner if their option price or the strike price is going to increase by like 1% a year. If the homeowner person going in that contract thinks home prices are going to rise over the next few years, like they could be securing a really good price for a house. But maybe their contract says that price is going to rise 5% every year. And how do you think about volatility in home prices and going into that contract? I mean, we're talking about there's a need for people entering into these agreements to have counseling, support, and understanding on the upfront to understand what a good agreement looks like.
Yeah, can you actually just say, I mean, it's maybe not superficially clear why the house price, the option price going up 5% a year is bad for the buyers. You just explain.
Yeah, so what it means is that there's a couple of reasons it could be bad. So I think over the past few years where we've seen home prices appreciate by like 18%, I think nationally or something like that. If you're able to lock in the right to purchase a house at a price that it was maybe back in 2016 plus a 1% increase a year, that means you're able to purchase a house for cheaper than you would have otherwise been. Like if you were to then purchase that house in 2020, you were able to buy it at a price that was cheaper than what it would have sold for on the open market. So you're getting a good deal. Right now, as we're seeing home prices flatten and potentially decline significantly in some markets, it means that if you sign a contract in which the price of the home goes up 5% every year, when you're looking 3 years down the line to purchase that home, you may be locked into purchasing that home at a significantly higher price than what it would currently sell for on the open market. And so in one way, that's a bad financial decision to pay for a home that is a higher cost that you may be attached to, that you may have invested maintenance into. And also you won't be able to get a mortgage. Traditional banks and mortgages will only underwrite you for a mortgage that's assessed at close to or 80% of the value of what the current value of the house is. And so you'd have to make up the difference between the mortgage you get for 80% of the house or 90% of the house, and then the cost that you've agreed to buy it at. And so what we'd be talking about is that a lot of these potential homeowners in these scenarios will automatically fail in their transition. They won't be able to, it won't make financial sense, nor they get financing to purchase a house. It's $50,000, $100,000 more than what it would sell for in the open markets. And they may still have to pay a fee when they move out, even though it's just that economics have not worked in their favor. And one thing we found that was interesting is a lot of companies we talked to were like, yes, we see that this might be happening. We can't have any formal policy on what may happen if a homeowner person wants to purchase a home there, the option price is much higher than market. Because if we have any policy, then it will just like wreck our whole business. But we know it's happening, and we know that we may have to be flexible, was basically all we could get people to say. But I think as we really think about people who are purchasing those contracts now or last year or the year before, who may several years from now be locked into agreements at much higher costs, I think it's something that we need to be really closely looking at and making sure those borrowers, future homeowners, are protected in those scenarios.
Yeah, and to be clear, right now, there is no protection for them, nor is there any data to understand how many of them will be sort of pushed out of their homes, unable to get a mortgage and transition as they were.
Have to be paying a $30,000, $40,000 move-out fee. That it really should not have to be paid morally by what they entered into. I do want to just do a couple things, and we moved on a couple things that I think could help these tools actually serve their purpose. I think one of them is thinking about clear maintenance rules. And so there was a wide variety that we looked at of how companies handled maintenance. For some, which I consider a better policy, the investor, or the person who owns title for the home, handled all maintenance. For some of them, or a few of the firms, they had the buyer paying for at least 50% of major maintenance. That could be major maintenance. That could be $10,000 to $20,000, and with no right that they'll transition to owning that home. I think having clear regulation and guidelines around maintenance, how maintenance is handled, and having most of that responsibility on the investor is one way we can make these contracts safer. Another practice is around these fees at the end if someone doesn't successfully transition to homeownership. I think you could explore ways in which having some type of fee helps incentivize certain behavior, but a 2 to 3% move out, 2 to 3% of the cost of the home as a move out fee is, in my hand, outrageous. And so thinking through what the regulation should be there. Another is thinking through whether there should be the lowest possible credit score that someone should be able to enter into some of these arrangements as. Because if you're selling someone a transition to homeownership, but you're bringing them into a home with a 450 credit score, saying that they'll be able to be at 650 2 years from now, that's just not, it's like really, really hard for any individual to be able to do that. And so any regulatory framework should look comprehensively at what is the financial profile of a person or a family coming into this contract that makes them likely to be able to transition, and potentially set some regulatory barriers around that.
Great. And I just want to say to the participants, we are about to move to Q&A. So if you have questions, please, again, drop them into the Q&A function. Don't use the chat. Please post your questions in Q&A. And before we get to that, John, I want to come to you on this question, which is, Hannah and Michelle kind of laid out some ways in which we might be able to create a context around these companies that would be more encouraging of moving people towards homeownership. If you were talking to an entrepreneur today who was starting a rent-to-own company, and they wanted to do the right thing, they really did want to maximize converting people to homeownership, what advice would you give them?
Yeah, so it's an interesting question because much of the opportunity that was born out of the sort of last cycle of this was fueled by bargain basement pricing, right? So, it's part of what gave rise to the CFD boom and the sort of new this sort of new iteration of RTO properties. And unfortunately, despite anticipation of some price softness, I don't feel like that necessarily exists today. And I think even with BFR models, the sort of built for rent, purpose-built single family rental properties, I don't feel like that it necessarily exists in that capacity today. What I would say to anyone who is seeking to start a business in in this industry is that it's possible to create a fair deal, right? And I think, and Michelle mentioned before, just morally, there are certain things that are just, they're objectively odious, right? That paying exorbitant fees to be able to leave a deal that still has a perfectly habitable home that can be relet, re-optioned, et cetera, is, it feels a lot like an operator seeking to line their pockets. I would say that there is an environment right now where the supply-demand dynamics make finding affordable options to occupy a property and to seek ownership. There's a huge base of demand for that, and I think that there are a lot of ways to be able to meet the mark. I think personally that this naturally occurring segment is ripe for innovation, and I think that there's a huge unmet demand by virtue of the lack of financing. So, in creating a business model that creates a fair deal, that accepts reasonable burdens of maintenance of ownership prior to transferring ownership to option buyers, to be able to be a part of helping to enhance that likelihood. So in particular, credit reporting. So many of these rent-to-own companies now have an enhanced capacity to enhance the credit visibility and the credit scores of their tenants by virtue of reporting, and Fannie and Freddie and others are, now looking to those credit proxies as a, key component of their underwriting to take full advantage of those sorts of opportunities to help enhance the likelihood that those families will buy. I think that the pull-through rate of being able to actually convert to ownership would be relatively high, especially at that segment of the market. And I think that there are opportunities to do that profitably despite the costs of building as well as the cost of buying today.
Great. And yeah, you make a great point that ultimately all these conversations come back to the fact that we are just not building enough housing, and the supply and demand in the housing market is a big driver. I want to go pull Marion in here, our director of content, who has been manning the chat and the Q&A. What questions do we have out there, Marion?
Yeah, well, we have some great ones in here, and thank you to everyone in this conversation. It's been really illuminating. We've gotten a lot of questions about, I think we are, so Hannah, you already touched on this a little bit, but we have a question about, even despite these arrangements being risky, a lot of people are still looking at them as ways to get inroads into homeownership. So what do you think are the best ways to support these potential buyers, get them information and get them support? And what do you think could be done better?
I can take first stab at that, although, yeah, I think my response is probably a version of what I've already said, which is that there should be robust third-party homebuyer counseling for folks that are thinking of rent-to-own or various forms of alternative or seller financing arrangements. Because of this history with contract for deed, which really relied on lying or deceiving the folks that entered into the contracts, that and sort of the practices that were built around that have transferred in some cases to other forms of alternative financing, and made it really hard, particularly for first-time home buyers, to understand what the implications of all of the contract terms that they're signing are. And even outside of the contract terms, what it means to be working on building up your credit while you're making these payments and doing the other things that we know can help you actually successfully transition to homeownership at the end of the contract. So in terms of buyer support, like really one-on-one individual buyer support, I'm an evangelist for making sure that there's homebuyer counseling from a third-party agency. And then, of course, I think there are structural things that we need to do around regulation, transparency, extending the sort of home mortgage disclosure or HMDA-esque data requirements that are on traditional mortgages to alternative financing as well.
I'll add in here, and this can touch on actually a couple of things I'm seeing in the Q&A too. Part of, and I know Catherine wants to talk about, which is part of the challenge of some of these emergent models is part of the challenge with some of these models is the type of financing that's backing them and how quote unquote expensive that financing is, as in how much money, if you take $1 million from an investor, how much money does that investor expect back in 1 year or 2 years? Do they expect 2 million back or 1.05 million back? And whatever that expectation is can really influence the pricing structure and the behavior of these sellers, of these institutions or individuals that are operating these seller financing. So we see a lot of these models are backed by venture capital, so startup capital to companies, which is a very expensive type of capital. That investor, if they give you $1 million, would ideally like $10 million back or $20 million back for that money from the growth of your company. Or if not backed by venture capital or a venture capital company, maybe they're getting money to actually purchase these homes from the private equity markets. That cost of capital can vary really widely. And John can speak to more what it is right now in this current economic environment. But think about that investor requiring like maybe 15 or 20% back on the money that they're taking. And that trickles through and influences the contract pricing, the fees that someone may charge. We've seen models that I think this model can work when the capital that's backing it is much less expensive. So when you're thinking about a government making an investment into these models, if you're thinking about nonprofit-backed models, potentially other types of capital like pension funds that can give money to a company for 15 or 20 years and only expect 5% of it back or 8% of it back. Like some of those things can then allow those pricing and economic pressures to be passed down to customers in a way that give them an arrangement that is they're more able to execute a fairer strike price on that house, fairer terms on whether or not they have the move-out fee, et cetera, et cetera. And so there's an opportunity both for new models, innovative models that seek out those sources of financing, and then also partnerships between government actors and some companies in order to provide this type of financing that can power fairer deals.
Yeah, John, can I actually ask you to weigh in on that capital question and how the source of capital for some of these companies influences their, impact on the buyer?
Yeah, absolutely. I would say both the return expectations as well as the sort of timetable, heavily influences the nature of the structure, as well as how patient a company practically can be, and both demonstrating the growth of their model as well as the sort of quid pro quo in the arrangements that they strike with families. So I think it's extremely important. I feel like those sources of capital are expanding. So companies don't have to rely as exclusively on venture capital as they may have had to, arguably, even a decade ago, as family offices and others are taking a more proactive role in both aligning their wealth with their values, as well as seeking actively to confront issues of homeownership. So I do think that there's opportunities there. To the previous question, I just say, really briefly, the opportunity that we really perceive is in trying to expand opportunities to finance properties themselves at this naturally occurring segment of the market. We really perceive that the inability to finance, even when you otherwise are, financially capable of sustaining a mortgage and reasonably financing, tends to be one of the primary impediments. So I think, crafting policy to help to create more of an inducement at that end of the spectrum, that could be CRA rules, that could be, addressing some of the aspects of legislation like Dodd-Frank that unintentionally create some barriers at the smaller balance end of the spectrum to be able to finance that, we think would have, very significant results. One of the things that really strikes us about the families that we serve is that we survey the families that we've converted to mortgages, whether from lease to own arrangements or contracts for deed. And what's interesting is that even more than the financial benefits that we provide, which are significant, it's the pride of ownership itself that motivates many of the families, and the concerns around the stability that it provides for their families, their children, and those sorts of pro-social outcomes that in many cases outweigh Many families enter into these arrangements and they're completely sober about the fact that it's not a traditional mortgage, that it's not a fair deal, but the lack of available alternatives compels them to enter into something that's otherwise financially precarious. So you have to create an alternative, or folks will continue to find their way into those markets. Marian,
what else do we have in there?
We got an interesting question in the chat, kind of going back to this idea of like less expensive forms of investment into this. Someone asked, would it work for community land trusts to use a non-exploitative RTO structure to help home buyers? Maybe I can pass.
Or Hannah.
Yeah, that might be.
First person with the microphone off gets it.
Yeah, as I mentioned before, there are not necessarily community land trust specific models, but nonprofit government funded backed models in Minneapolis in particular that are using, they're actually using contract for deeds there. But replicating some of the best practices that we've outlined on this call from rent to own and that John has mentioned around, ensuring that the home prices are naturally occurring, or the homes are naturally occurring affordable, that there are certain credit standards, but that they're not cost prohibitive. In the instance in Minneapolis, they're also working on doing positive credit reporting for the folks in those programs. So helping them build up their credit and remove those barriers to homeownership. And I think one of the things that they're also doing is once the buyer has actually removed those barriers to homeownership, they're doing everything they can to get them out of the CFD contract and into a traditional mortgage. So yes, I do think it can work for nonprofits, for various types of community land trusts or other, mission-driven organizations and entities to work on this. And as we've seen in other places, they just have to have those guardrails.
Yeah, I mean, in theory, any entity, it's an unregulated market, so anybody can do it. If you have the money to buy the property and you want to, you have the wherewithal to structure a contract to a potential buyer, then any entity could do it. Right, Michelle?
Yeah, I think, the community land trusts, my understanding of the term is when the ownership of the land retains with the person operating the land trust, so a nonprofit, and then the ownership of the actual house is with the person who's moving into it. And so you could execute a rent to own on that ownership of the house in a way that is structurally beneficial to the home buyer. If I can quickly address it, I saw one thing come, if it's okay, Marian, the basis of valuation of the single family home and for the rent part. This isn't something that I've dug into very much. On paper, a lot of the companies say that they set the rent based on fair market rent within the area. However, a lot of these properties may exist within a neighborhood where there aren't that many rental properties, where a lot of people are owning the house. And so how you set fair market rent is difficult. I encourage people to look at an article that recently got published in Fast Company, I believe, that looked into one company, Divvy, and how they set rent. I think it is, however, really hard. A lot of the companies have algorithms powering how they set this rent. Some of the models that we spoke to that maybe that had other sources of financing justified that they thought it was fairer to set rent equivalent to what a mortgage would be on that property under similar terms, and as opposed to what the rent was like. And usually what that mortgage would be lower than what a fair market rent would be, as another way to think about the appropriate pricing structure.
Thanks for that clarification. So we're at the end of our time. I know there were more questions in there that we didn't get to, and appreciate all of you showing up. I did post a link to the paper in the chat. We will also send it in the follow-up email along with the Divvy article that Michelle mentioned, so that you can, the Fast Company article about Divvy, so that you can read more. I will just say to end, for those of you who were asking, like, who's doing this well, what are the examples? Our purpose here wasn't to sort of rank or make value judgments on individual companies. Our purpose here was to really paint a picture of what this industry looks like right now, and to highlight the fact that there not being any standards makes it really hard for even researchers, let alone the people who are trying to purchase the properties to make that kind of evaluation themselves. So I encourage you to read the report, look at the comparisons we make in the report, and then continue to work with Tech Equity as we move forward. We plan to keep this issue at the front of mind, both for the companies who are working in this space, but also for the regulators who we hope will start creating some more standards and frameworks around the actors in the space, as it is likely to only grow as the housing market has nowhere on the horizon looks to be getting easier for buyers. So thanks to you all for joining us. Look for that follow-up email, and join me in thanking the panelists for this really great conversation. Thanks, everybody.